Welcome back to the channel. And as always, if you're copy trading, you're an absolute moron and you deserve to lose all your money. This information is for educational purposes only. And with that out of the way, we're going to look at a stock today. It's Chinese American Depository Receipt, ADR. Name of the company is KE Holdings, ticker BEKE. And what these guys do, they are essentially a real estate brokerage platform, very popular in China, quite sizable in terms of their size, as the market cap is almost 20 billion, which is the reason why I started to look at this company in the first place. I was looking at shorts, and that's a market cap that we typically flock towards, looking for that kind of profile. But also, I thought it was interesting to take a look at getting exposure to Chinese real estate. Now, one of the things that caught my attention when I first started looking at this is that all the analysts have this company on a buy, despite the fact that the PT has remained stagnant for months, and their analyst, the sell side analyst community price target is way, way above the current price and it's remained so during months. So the question that I was asking myself back then is, okay, why has the stock not been downgraded? And admittedly, if we take a closer look at this chart, we are a little bit late to the party here, guys. This is a company that, as you can see, has dropped from $70 and has kind of stayed sideways for almost a couple of years now. So why am I looking at this again? Well, first I started looking at the company around here, around January, February, and back then I felt that the technicals and the fundamentals have well didn't provide much juice for us to start looking at this. However, as you can see, over the last few weeks, the stock has gone from 12.50 to the current price levels at just over 14. We've come from a situation where the stock is literally dropped from the SMAs back into that territory, and I think we are potentially finding a situation down the line where it could drop back from those levels into this support that we found. But of course, I'm not making this decision purely on a technical perspective. There's reasons why I'm looking at this. So first of all, we have to bear in mind that whilst this company has some competitors in the sector, right? So typically we would look at companies like Cushman and Wakefield. We look at CBRE, JLL. Those are companies that are part of the same sector, but we don't really follow those as like to like because their business model is quite different. Those are the guys are more like real estate brokers in the typical sense, in the traditional sense. While these guys are more of an online platform, and that includes for both primary and secondary market. Now, when we look at that, um, we do find organizations like Zillow, which are selling at a almost three times the earnings that this company is selling into. But as I put this on my watch list and kept developing my view about the sector, I came across a very interesting stock, which is called Redfin, trading in the United States. And the reason why they didn't come across that company in the first place is because it's a company that has a market cap of just about 600 million. Is well below what I normally look at for my tradable universe. So ticker for that, RDFN. And we see here, that's a company as well that has followed a very similar trajectory. However, we have to bear in mind that this is an American stock. Typically, the companies that are American are traded at a higher premium. than Chinese for various reasons, right? Now, um, I'm not able to show you in this platform at the moment the PE. However, the price to sales for this company is 0.6 times, whilst with KE Holdings, we're getting 1.5 times. So we're getting a price to sales 3 times bigger than a close competitor in terms of business model, and that is also American. So that to me shows that potentially there could be room for the valuation to continue going down. Additionally, when you look at Redfin, this is a relatively crowded trade at the moment, and it has been so for quite some time, reaching highs on the short interest of almost 30% and remaining fairly elevated ever since. So currently is at 18 times, right? And again, is likely not the kind of trade that is going to provide an explosive move to the downside for people to capitalize on a short move. So my thought process here is, well, what if the United States real estate sector starts turning around as the economy is proving quite resilient, or simply does it faster or before the China real estate sector does? So that's why I revisited this company, KE Holdings. And another reason why I gave myself some time to look at it is because when I started um, screening this company, I noticed that they had the earnings taking place on the 17th of March, where they reported earnings. So that's about here, right after this big move up. So what happened there? Well, the company actually had a good beat in terms of the results. They were better than expected. However, the shares fell due to investor concerns about the market in the near term. So the stock dropped and is now sitting in a similar price point than when I started looking at it. So I think, like I said before, we're gonna get another downside move like the one we've seen here. And what do I think that? Well, there's a number of things that are taking place at the moment that we should be cognizant about. So first of all, the stock is still on a price target of $24 by the analyst community. Again, that's been sitting there for a long, long time and is not being changed by these analysts. Now, in terms of what also happened, their expectations were revised up in terms of revenue, EBITDA, and earnings, only to be revised down right after. And now they are even lower than they were before. So let me just share with you some snapshots here as to how that translates. So you can see here that in terms of expectations, we got turnover that got decreased right here. Earnings per share, you have to see at 2024 as this green bar in the middle. You see how that was raised just to be dropped immediately. And then the same happens with EBIT. So there's uh, there's a material change in what the market is expecting out of this stock. So that's one strong indicator, which in my mind does not justify this move up that we had over the last few weeks. Now, the other thing as well is that the bulk of their business is the sale of new homes, which is 40%, excuse me, 47% of the revenues. The secondary market, sales of existing homes, is about 40%. Now, on the 1st of March, Fitch Ratings cut their forecast for China's housing market to a 5 to 10% decline in new home sales for the rest of the year, right? For the whole 2024 period. Now, with a slower recovery likely to have wider effects on local governments, banks, and asset management companies, I think that is quite significant. It could have a greater impact into house prices, which of course is going to affect them because they take a commission out of the houses and as well as the volume. In the past, a positive report from Fitch in early 2023 predicted an improvement in the property sector, and that led to some improvement in the stock, as you can see over here. But now we are sitting at a very, very similar price point, and their prediction is to the downside. So I would imagine that we can revisit these levels over here. There's also an interesting announcement made by the company during this earnings call, and that is that they will be now paying a cash dividend of $400 million. That's about 35 cents per ADR. Now, obviously, that is good if you're a shareholder, but it does put pressure into the margins of the company. It puts a lot of pressure to deliver those numbers. And in the event that that dividend doesn't become sustainable, or maybe the cash flows, the earnings of the company go in their entirety to pay for that, then we could see the stock going down. Now, there was quite a few things to unpack in this one. And what I noticed as well is that when we look at this company, we mentioned the market cap before, but it is quite representative in terms of the exposure that it has in the broader market. So what do I mean by that is, well, first of all, this company, as you can see here, forms part of an index, which is this one that you can see here, KWEB, KWEB. This is a China ETF where the company has a significant weighting. I think it's from memory near the 10% mark. As well, what I've done is to compare the performance of the stock versus the main indices. So I'm looking at FXI, which is also a China ETF, and also Hang Seng. And the interesting thing is that year to date, all these indices have outperformed the stock, right? What happens if we look at a 1 year period? We get an even greater underperformance. If we look at a 2 year period, yes, that was a period where the stock did better than the rest of the market. But overall, if we look at again a longer time frame, 5 years, we get a significant underperformance as well. So one of the risks that I see for this trade is that precise weighting in the ETF could become a bit of a problem if, for example, the market changes direction and investors turn really bullish. That could drive the market up, which is always a problem when you have a short, right? Maybe you have some short exposure in your book, the market rallies as a whole, and all your shorts get out of the money. That's if you're doing options. But with this one, we see an underperformance versus the rest of the market. So I think it's something I want to put in the short book because of that. I could not find a reliable short interest indicator for this stock. However, I had a look at the outstanding shares in various resources, and the numbers that I have worked out indicate somewhere around 1.6% short interest. Again, that's not crowded at all if we compare that to this company that I alluded before, Redfin. And um, this company as well was listed fairly recently, was listed at the end of 2020. My experience in companies that go through that part of the cycle is that the first few years they do underperform. There's high expectations going to the IPO. There's investment bankers propping up the stock at the beginning so it doesn't fall into the toilet and allows for liquidity. But at some point, uh, past that mark, and that's quite obvious, dictated by the price action, it's not unusual to see stocks that were trading at these prices that we see here, right? 30, 60, go all the way back down to the low tens, which is where we are, but obviously even beyond. As we've seen here, this is a major resistance, excuse me, support point. I think we can easily retest that and potentially even go lower if we look at a uh, longer time frame. Now, in terms of what could drive this, there is an interesting exposure that I've found by institutional investors. So we got some recent purchases by the guys at Vanguard, Wellington, Dodge and Cox. We got Fidelity, and we got DZ Bank and DRW Securities. I'm not a massive expert about what each one of these companies do. I know some of them, but from what I've seen on the type of investor that they are, they're not really smart money. They're institutional money. They're slow money. So I don't think that this is a whale movement that we have to be too concerned about. These guys, some of them are actually value investors, right? That think their shares are undervalued. And it could be the case. It could be the case that they are, but as the saying goes, if stocks are cheap, they are for a reason. I think the company is going to experience significant headwinds down the line. Arguably, it's a very, very competitive sector, and it doesn't seem that the economy in China is recovering for the time being. Now, of course, there are some risks as with any other trade. And in this particular case, I alluded already to the ETFs potentially being a factor driving the price. But I think, in my view, the greatest risk that we have here with this one is the yield that is providing, which is actually not bad. So when you look at the earnings yield plus the dividend that has been recently announced by the board of directors, the company is actually providing an aggregate 8.7 yield, which is quite attractive if you compare that to treasuries. Now, I would expect that earnings to disappoint, and that's likely why I'm going to play this with a calendar spread that offers me exposure to one or preferably two earnings reports, because I do think that there will be a significant miss, not necessarily huge, but maybe a 10% miss on EPS. So the way I'm going to play this is probably uh, a structure with options, with puts, where I'm going to be looking to go long the August and short the 17th of May. And thankfully, it's a stock that has plenty of liquidity in the options market. There's plenty of expiries. So it gives me the opportunity to keep rolling the short leg as those expiries come through. So hope you enjoyed that and see you soon.